There is a ghost in the machine of the financial markets. It's an invisible force that has destroyed more wealth, shattered more dreams, and humbled more geniuses than any market crash or economic depression in history. It isn't a complex algorithm, it isn't a shadowy cabal of Wall Street insiders, and it isn't a lack of information. It's something far more intimate, far more primal. It lives inside of you. It lives inside of me. Warren Buffett, the man who has navigated the treacherous currents of the market for over 70 years, building a fortune that defies comprehension, has given this ghost a name. He doesn't call it stupidity. In fact, he's found that stupidity is rarely the problem. The world is filled with brilliant people, individuals with stratospheric IQs, people who can deconstruct complex financial statements in their sleep, who fail, time and time again, to build lasting wealth. The real culprit, the true ghost in the machine, is a failure of temperament. The single greatest mistake that smart people make is believing that their intelligence is their greatest asset in the world of investing. Buffett's entire life, his entire philosophy, is a testament to a different, more profound truth. That in the arena of money, emotional control doesn't just matter more than intellect. It is the only thing that matters. This isn't a lesson about picking better stocks. This is a lesson about rewiring your own brain, about forging a new kind of stock market mindset, one built not on genius but on discipline. It is the final promise of value investing, that you don't have to be the smartest person in the room to win. You just have to be the most sane. And today, we are going to dissect that sanity, break it down into its core components, and build a fortress of financial discipline around your portfolio, one that can withstand any storm the market throws at it. This is the blueprint for conquering the enemy within. Our first pillar in constructing this fortress is perhaps the most counterintuitive for any intelligent person. It is the principle of intellectual humility, which Buffett famously codifies in his concept of the circle of competence. The idea is devastatingly simple. Every individual, through a combination of professional experience and dedicated study, has a few areas where they possess genuine, deep-seated knowledge. This is their circle. Inside this circle they have a massive advantage. Outside of it they are no better than anyone else, and are likely much worse, because their intelligence gives them the false confidence to play a game where they don't know the rules. The greatest temperamental failure of a high IQ individual is the seductive whisper of their own ego, telling them that because they are smart, they can understand anything. Buffett's temperament provides the crucial counter-narrative: know what you don't know, and stay away from it. This isn't about limiting your potential, it's about concentrating your power. It is the ultimate act of risk management. The most potent illustration of this principle in action took place during one of the most euphoric and ultimately catastrophic periods in modern financial history, the dot-com bubble of the late 1990s. As the millennium approached, the world was gripped by a technological fervor that bordered on religious. A new paradigm had supposedly emerged. The old rules of business, of profits, of cash flow, were declared obsolete relics of a bygone industrial age. The new currency was eyeballs, user growth, and a compelling story about changing the world. Companies with no revenue, no profits, and often no viable business plan were going public and seeing their valuations soar into the billions overnight. It was a gold rush, and anyone who questioned its logic was branded a Luddite, a dinosaur, a man hopelessly out of touch with the future. And the chief dinosaur, according to the titans of tech and the gurus of Wall Street, was Warren Buffett. By 1999, Berkshire Hathaway was dramatically underperforming the market. The S&P 500, fueled by tech giants like Cisco and Intel and a host of flimsy dot-com startups, was posting returns of over 20%. Berkshire, full of stodgy, old-economy businesses like insurance, furniture, and candy, was actually losing money. The pressure on Buffett was immense. It came from all sides. Shareholders wrote angry letters. The financial press, most famously in a Barron's cover story titled "What's Wrong, Warren?", openly mocked him, suggesting his folksy, value investing approach was dead. The article portrayed him as a man who had lost his touch, a relic who simply didn't get it. Even titans of the new economy took shots. Andy Grove, the legendary CEO of Intel, a company Buffett famously refused to buy, publicly questioned Buffett's relevance. The emotional weight of this public ridicule cannot be overstated. Imagine being told by the entire world that your life's work, the very philosophy that made you a legend, is now obsolete. The temptation to capitulate, to prove you're still smart, to show you can play the new game, would be overwhelming for almost any human being. The average investor, watching their neighbors get rich on stocks like Pets.com or Webvan, felt an unbearable fear of missing out, a primal envy that compelled them to dive in. For a man of Buffett's intellect, the temptation would be different, but just as powerful: the intellectual challenge, the ego-driven desire to prove he could master this new frontier. But Buffett's temperament, his unwavering commitment to his circle of competence, acted as an unbreakable shield. He would tell interviewers, with a calm, almost frustrating simplicity, "I don't know how to value these companies." He admitted that he had no idea which of the hundreds of new technology firms would be the winners in 10 or 20 years. He couldn't project their cash flows because their industries were changing too quickly and their competitive advantages were too uncertain. He explained that a company like Coca-Cola or Gillette had a durable competitive advantage that he could understand and, to a reasonable degree, predict. He knew that in 20 years, people would still be drinking soda and shaving. He had no such certainty about which search engine or e-commerce platform would dominate. So he did nothing. He sat on a mountain of cash, patiently weathering the storm of criticism, watching the mania unfold from a safe distance. His inaction was not born of ignorance, but of a profound and disciplined self-awareness. It was an act of supreme self-control. Then, in March of 2000, the bubble burst. The Nasdaq, which had soared to over 5,000, began a brutal, soul-crushing decline that wouldn't bottom out for another 2.5 years. It ultimately lost nearly 80% of its value. Companies that had been worth billions were wiped from existence. The paper fortunes of the day traders and the tech gurus evaporated. The geniuses who thought they had discovered a new paradigm were ruined. And Warren Buffett, the dinosaur, was vindicated in the most spectacular fashion imaginable. The cash he had patiently held was now incredibly valuable in a world starved for capital. He was able to deploy it, buying wonderful businesses at bargain prices from people who were forced to sell. His adherence to his circle of competence didn't just save him from the crash, it positioned him to profit immensely from it. He didn't need a high IQ to predict the crash. He just needed the temperament to admit what he didn't know and the financial discipline to stay away. The psychological engine driving this catastrophic failure of otherwise brilliant people is a potent combination of the Dunning-Kruger effect and the overconfidence bias. The Dunning-Kruger effect, first described by psychologists David Dunning and Justin Kruger, is a cognitive bias whereby people with low ability at a task overestimate their ability. But a more subtle and dangerous corollary applies to highly intelligent individuals. When someone possesses genuine expertise in one complex domain, say software engineering or corporate law or medicine, their brain often creates a halo effect. This success generates a powerful feeling of general competence and emotional confidence that bleeds over into areas where they possess no real expertise. They mistake their general intelligence for specific, applicable knowledge. This is the overconfidence bias in its most destructive form. An intelligent person knows they are capable of learning complex things, so they dangerously underestimate the difficulty and nuance of a new domain like investing. They see the market with its charts and numbers, and it looks like a solvable puzzle, another intellectual challenge to be conquered. On a cerebral level, this is a failure of metacognition, the ability to think about one's own thinking. A person with a high IQ might be a brilliant problem solver, but if they lack the metacognitive skill to accurately assess the limits of their own knowledge, that problem-solving ability becomes a weapon turned against themselves. The emotional drive behind this is powerful. Smart people are often rewarded their entire lives for tunbers having the answer. In school, in their careers, they are the ones people turn to for solutions. This creates an identity, an ego, that is deeply intertwined with being right and appearing competent. The phrase "I don't know" can feel like a personal failure. In the dot-com bubble, admitting you didn't understand the valuation of a company like GeoCities felt like admitting you were a fool. The emotional pain of feeling left behind, of feeling stupid, was greater than the rational fear of losing money. True temperament, in this context, is the ability to decouple your ego from your investment decisions. It's the strength to say, "I don't know," and feel no shame, only prudence. It's the recognition that in the world of investing psychology, the three most important words are not "I love you," but "I don't know." This is a battle fought not on a spreadsheet, but in the deepest recesses of one's own identity. So how can we translate this powerful abstract principle into a concrete, actionable tool? The blueprint for applying the circle of competence is a rigorous, honest, and ongoing process of self-evaluation. It is about building a fence and knowing with absolute certainty which side you are standing on before you ever risk a single dollar. Step 1 is to perform an honest intellectual inventory. Take out a piece of paper or open a new document. Create 2 columns. In the first column, list your professional expertise. What do you get paid for? What industry have you worked in for 5, 10, 20 years? Be specific. If you're a software engineer, don't just write tech, write enterprise cloud-based data storage solutions. If you're a doctor, don't just write healthcare. Write non-invasive cardiology. This is the core of your circle, the ground you know better than almost anyone. This is where your professional life has given you an informational and analytical edge. Step 2 is to populate the second column with your deep, genuine hobbies and passions. This isn't about things you find mildly interesting. This is about subjects you have studied with the same rigor you would apply to a job, but for no pay. Maybe you're an amateur historian of the railroad industry. Maybe you've spent years homebrewing beer and understand the supply chain for hops and barley inside and out. Maybe you're a devoted gamer who deeply understands the business models of video game publishers. These areas, born of passion, often represent islands of profound knowledge that can be just as valuable as professional expertise. Step 3 is the crucial act of drawing the circle. Look at your 2 lists. The intersection of these areas, and the areas immediately adjacent to them, constitutes your circle of competence. It's probably smaller than you'd like it to be. This is a feature, not a bug. Your goal is not to have the biggest circle, but to have the most clearly defined one. This circle represents the businesses whose products, competitive advantages, and market dynamics you can explain to a 10-year-old with clarity and confidence. Step 4 is to create what Charlie Munger calls the too hard pile. This is where your temperament is truly tested. Everything that falls outside your freshly drawn circle, no matter how exciting, no matter how much you read about it on the news, no matter how much your friends are making from it, goes directly into the too hard pile. The latest biotech breakthrough? Too hard. A complex financial derivative? Too hard. A speculative cryptocurrency? For most people, too hard. The act of physically or digitally placing an investment idea into this pile is a powerful ritual of self-control. It is a declaration that you will not let ego or envy tempt you into a game where you are the patsy. Step 5 is the ongoing process of maintenance and expansion. Your circle is not static. You can expand it, but only slowly, deliberately, and with genuine intellectual curiosity. Adopt what author Julia Galef calls the scout mindset over the soldier mindset. A soldier's job is to defend a position at all costs. Their identity is tied to their existing beliefs. A scout's job is to go out, see what's really there, and draw an accurate map. When you decide to learn about a new industry, approach it as a scout. Spend at least a year reading, studying, and learning before you even consider investing $1. This long-term educational commitment acts as a filter, weeding out passing fancies and ensuring that any expansion of your circle is built on a foundation of true knowledge, not fleeting interest. This is the practical application of value investing principles to your own investor education. To truly understand the wisdom of this path, we must examine its opposite, the path walked by the 99%, a road paved with brilliance and littered with wreckage. The most spectacular and cautionary tale of intellect untethered from temperament is the rise and fall of long-term capital management, or LTCM. If you were to build a firm based on pure IQ, you couldn't have done better than LTCM. Its boardroom was a pantheon of intellectual giants. It was founded by John Meriwether, the legendary bond trader from Salomon Brothers, and its partners included Myron Scholes and Robert C. Merton, who, in 1997, at the height of LTCM's success, would win the Nobel Prize in Economics for their groundbreaking work on options pricing, the famous Black-Scholes model. These weren't just smart guys. They were the men who wrote the very textbooks the rest of Wall Street used. They were the high priests of financial theory. Their strategy was, on the surface, intellectually elegant. They used complex computer models to find tiny, temporary discrepancies in the prices of related bonds around the world. For example, a newly issued U.S. Treasury bond might trade for a fraction of a penny less than an older, less liquid bond with the same maturity. LTCM would buy the cheap one, sell the expensive one, and wait for the prices to inevitably converge, pocketing the tiny difference. The strategy was called convergence trading. The profit on any single trade was minuscule, so to generate meaningful returns, they had to do two things: make thousands of trades and use breathtaking amounts of leverage. For every $1 of their own capital, they borrowed more than $25. They had built what they believed to be a scientific money machine, a system so intellectually sound that it was virtually risk-free. Their models, they believed, had tamed the irrational beast of the market. For 4 years, it worked with astonishing success, generating annual returns of over 40%, crushing the market and making its partners astoundingly rich. They were the kings of the universe, their intelligence seemingly validated with every decimal point of profit. Their circle of competence was in identifying these specific, esoteric bond market arbitrage opportunities. But their success, their godlike returns, and their stratospheric IQs created a fatal case of overconfidence. Their ego began to whisper that their models could be applied anywhere. They strayed, venturing into areas far beyond their core expertise. They began making massive leveraged bets on mergers and acquisitions, on the direction of stock market volatility, on international equities. They were no longer arbitraging tiny pricing errors. They were making directional bets on the future, just like any other speculator. They had stepped outside their circle, believing their genius was a universal key. In August 1998, Russia defaulted on its domestic debt. This was an event so far outside the statistical probabilities of their models that it was considered a near impossibility, a so-called 10 sigma event that shouldn't happen in the entire history of the universe. But it did. The default triggered a global flight to safety. Investors around the world panicked and dumped everything risky, piling into the most liquid, safe U.S. Treasury bonds. The very price discrepancies that LTCM was betting would converge began to diverge, violently and catastrophically. The risk-free machine went into reverse. The leverage that had magnified their gains now magnified their losses with terrifying speed. In a matter of weeks, the firm with over $4 billion in capital, controlling positions worth over $1 trillion, was on the brink of complete collapse. They had lost more than 90% of their equity. The smartest men in the room were bankrupt. The situation was so dire, their positions so large and intertwined with every major bank on Wall Street, that the Federal Reserve had to orchestrate a multi-billion-dollar bailout to prevent the collapse of the entire global financial system. The men who had won the Nobel Prize for their theories on risk management had generated the single greatest financial risk of the decade. Their intelligence was their undoing. It gave them the arrogance to build a bomb and the blindness to sit on top of it. The financial connection here is brutally direct and quantifiable. Adhering to a circle of competence is the most powerful form of risk management because it directly prevents catastrophic loss. An investor who stays within their circle might miss out on the occasional high-flying stock in an industry they don't understand, but they will also, with absolute certainty, avoid the devastating blow-ups that come from speculating in areas where they are at a massive informational disadvantage. The financial impact isn't about slightly beating the market. It's about avoiding the negative 50, 60, or 90% events that permanently impair your capital and destroy the power of compounding. Think of two portfolios. Portfolio A is a concentrated collection of 5 to 10 businesses that the owner understands deeply. Portfolio B is a diversified collection of 50 different stocks, including speculative tech, biotech, and mining companies the owner read about online. During a stable bull market, Portfolio B might even outperform. But during a crisis, when the speculative froth is blown away, Portfolio B will be decimated. The owner won't have the conviction to hold on because they never understood what they owned in the first place. Portfolio A's owner, grounded in deep knowledge, will not only hold, but may even see the crisis as an opportunity to buy more of the great businesses they understand. The first investor preserves and grows their capital through the cycle. The second is wiped out. The difference is not intelligence. It is the temperamental discipline to stay within the circle. Once an investor has established the humble boundaries of their knowledge, they must then confront the market itself. And to do that, they need a robust mental model for dealing with its wild, often terrifying mood swings. This brings us to our second pillar, mastering the allegory of Mr. Market to conquer the primal emotions of fear and greed. Buffett learned this concept from his mentor Benjamin Graham, and it is perhaps the single most important piece of investing psychology ever articulated. The idea is to imagine the stock market not as an omniscient, all-knowing entity, but as a manic-depressive business partner. Every day, this partner, Mr. Market, shows up at your door and offers to either buy your shares in a business or sell you his. Some days, he is euphoric. He sees nothing but a rosy future and offers you ridiculously high prices for your shares. Other days, he is inconsolably pessimistic. He is convinced the world is ending and, in a fit of panic, offers to sell you his shares at absurdly low prices. The crucial insight is this: Mr. Market is there to serve you, not to guide you. You are free to ignore him completely. You are not obligated to trade with him. You only engage when his mood offers you an opportunity. If he is pessimistic and offering you a price far below your own calculation of a business's intrinsic value, you buy. If he is euphoric and offering you a price far above that value, you sell. If his price is reasonable, you do nothing. You go about your day. A person with high intellect but poor temperament sees Mr. Market as a source of information. They think, the market is down today, it must know something I don't. They get scared. They see the market soaring and think, everyone else is getting rich, I must be missing something. They get greedy. A person with strong temperament sees Mr. Market's quotes for what they are: noise. Their anchor is not the market's price, but their own independent valuation of the business. Temperament allows you to be indifferent to the madness of the crowd. One of the greatest examples of Buffett leveraging a pessimistic Mr. Market was his investment in the Washington Post in 1973. To understand the emotional context of that time is to understand the power of Buffett's temperament. The country was in a state of profound turmoil. The Vietnam War was dragging on. President Nixon was mired in the Watergate scandal. Inflation was soaring. And the 1973 oil crisis had sent the economy into a deep recession. The stock market had been crushed. It was a period of intense national anxiety and pessimism. There was a pervasive feeling that America's best days were behind it. In this environment, Mr. Market was not just pessimistic, he was suicidal. The Washington Post Company, which owned the iconic newspaper Newsweek magazine and several television stations, saw its stock plummet along with the rest of the market. The company itself was embroiled in the Watergate scandal, as its reporters, Woodward and Bernstein, were relentlessly pursuing the story that would ultimately bring down the president. While this was a journalistic triumph, It made the company a political pariah and created immense uncertainty. Wall Street hated the stock. The entire public market valuation of the Washington Post Company fell to around $80 million. But Buffett, sitting in his quiet office in Omaha, did his own analysis. He ignored the screaming headlines and Mr. Market's panicked quotes. He looked at the underlying businesses. He knew that the newspaper had a virtual monopoly in Washington, D.C., a durable competitive advantage. He knew that the television stations were high-quality, cash-gushing assets. By his conservative calculation, the company's assets were worth at least $400 million, maybe even $500 million. And Mr. Market, in his fit of depression, was offering to sell him the entire company for $80 million. It was like being offered a $5 bill for $1. The intellectual part was easy. Any smart analyst could have done that math. The hard part was the emotional fortitude required to act. It meant betting on the long-term future of American institutions, at a moment when patriotism and optimism were at a low ebb. It meant buying a politically controversial stock in the middle of a brutal bear market. It meant calmly writing a check for over $10 million, a huge sum for Berkshire at the time, while everyone else was panicking and selling. Over the next 30 years, that $10 million investment would grow to be worth more than $1.5 billion, a return of over 150-fold. This wasn't a return generated by a complex algorithm or insider information. It was a return generated by the simple, temperamental ability to say thank you to a depressed Mr. Market. The psychological demon that Mr. Market preys upon is one of the most well-documented and powerful biases in behavioral finance, prospect theory, and its most famous component, loss aversion. Developed by Nobel laureates Daniel Kahneman and Amos Tversky, prospect theory demolishes the classical economic idea of a rational, utility-maximizing investor. They discovered, through a series of ingenious experiments, that humans experience wins and losses in a profoundly asymmetrical way. Specifically, the emotional pain of losing a certain amount of money is roughly twice as powerful as the emotional pleasure of gaining the same amount. Losing $100 feels as bad as gaining $200 feels good. This is loss aversion. Our brains are hardwired from our evolutionary past to be exquisitely sensitive to threats and losses. A caveman who missed out on a berry bush felt a little disappointed. A caveman who ignored a rustle in the grass that turned out to be a saber-toothed tiger was removed from the gene pool. We are the descendants of the anxious and the paranoid. This deep-seated wiring has devastating consequences for investors. When the market falls, as it did in 1973, the decline is not processed as a simple numerical change on a statement. It is processed in the limbic system, the primal part of the brain, as a threat. The pain of seeing your portfolio value decrease triggers a fight-or-flight response. The urge to make the pain stop by selling is overwhelming. Mr. Market's lowball offer is perceived not as an opportunity, but as a confirmation of the threat. Conversely, when the market soars, the less powerful, but still potent, emotion of greed kicks in, coupled with the fear of missing out. Mr. Market's euphoric high price is seen as a social signal that we are being left behind. Intellect is a poor defense against these primal emotions. You can know, intellectually, that you should buy low and sell high. But when your portfolio is down 30%, your primal brain is screaming, "Danger! Sell now!" Temperament is the trained, disciplined prefrontal cortex stepping in and overriding the panic signal. It's the calm voice that says the feeling is real, but the danger is an illusion. The lower price is not a threat, it is an opportunity. Mastering Mr. Market is, therefore, not an intellectual exercise but an act of emotional self-regulation, a core component of any effective stock market mindset. How do we build this emotional callus, this indifference to Mr. Market's daily tantrums? We need a practical blueprint that transforms our relationship with the stock market, from that of a gambler watching a roulette wheel to that of a business owner monitoring their assets. This is the business owner simulation mental model. Step 1 is to change the act of buying. The next time you purchase a stock, you must immediately perform a ritual. You are not allowed to simply click buy. You must first open a document and write down in at least 3 well-reasoned paragraphs why you would be perfectly happy to own this entire business if the stock market were to shut down for the next 10 years. You must articulate its competitive advantage, its long-term prospects, and its management quality. This act forces you to shift your perspective from renting a flickering ticker symbol to owning a piece of a tangible, operating enterprise. This document becomes your anchor. Step 2 is to break the addiction to the price ticker. Daily price quotes are the engine of Mr. Market's emotional manipulation. You must starve him of your attention. Delete the stock market app from your phone's home screen. Remove the market bookmarks from your browser. Commit to checking your portfolio on a set schedule, and no more often. A good starting point is once a month. A better one is once a quarter, which is how often a real business owner gets a formal report. This intentional friction creates emotional distance, preventing the primal brain from reacting to meaningless daily noise. Step 3 is to reframe the information when you do check the price. You are not looking at your score or how much money you've made or lost. You are viewing Mr. Market's daily offer. If the price is significantly higher than when you bought, your internal monologue should be, Mr. Market is feeling euphoric today. He's offering to buy my wonderful business for a very high price. I don't think I'll sell today, the business is worth more. If the price is significantly lower, your monologue should be, interesting. Mr. Market is in a panic. He's offering to sell me more of this great business at a discount. Perhaps I should take him up on his offer. This simple reframing exercise transforms you from a passive victim of market volatility to an active, opportunistic business owner. Step 4 is to mechanize your response to opportunity. The best way to defeat emotional decision-making is to make the decision before the emotions kick in. Set up an automatic investment plan that buys a set amount of your chosen stocks or index funds every single month, regardless of the price. Even more powerfully, create a crisis plan. Write down specific price levels for the stocks you own at which you will commit to buying more. For example, if stock X, which I have analyzed and believe is worth $150, falls to $100, I will invest an additional $5,000. If it falls to $80, I will invest another $10,000. By pre-committing to action, you turn a moment of future panic into a moment of automated, rational execution. You are using your calm, intelligent self today to protect your future, emotional self from making a terrible mistake. This is the essence of long-term investing discipline. The antithesis to this disciplined approach, the path of the 99%, is on full display during every market crash. We don't need to look back to 1973. The behavior is timeless. Consider the global financial crisis of 2008. As the subprime mortgage crisis unfolded and Lehman Brothers collapsed, Mr. Market descended into a state of pure, unadulterated terror. The S&P 500 would ultimately fall by more than 50% from its peak. For the average investor, this was not a theoretical exercise. This was their retirement, their children's college fund, evaporating before their eyes. The emotional pain, the loss aversion, was excruciating. And how did they react? Exactly as their primal brains told them to. Data on investment fund flows from that period tells a brutal story. In the final quarter of 2008 and the first quarter of 2009, precisely as the market was bottoming out, retail investors pulled hundreds of billions of dollars out of equity funds. They sold at the point of maximum pessimism, the point of maximum opportunity. They locked in their catastrophic losses, turning temporary paper declines into permanent capital destruction. They listened to Mr. Market's terrified screams and joined him in the stampede for the exit. Then, of course, after the government interventions and the slow return of sanity, the market began one of the greatest bull runs in history. But the people who had sold at the bottom were too emotionally scarred to get back in. They waited, paralyzed by fear, watching the market go up 20%, then 50%, then 100%, always feeling it was too late to get back in. Their panic selling was not a single bad decision, but two. They sold at the worst possible time and failed to participate in the inevitable recovery. This is the devastating emotional whipsaw that destroys wealth far more effectively than any single bad investment. It is the core failure of trading psychology driven by a complete misunderstanding of Mr. Market's role. The direct financial connection of mastering this principle is the very engine of wealth building. It is the difference between harnessing the power of compounding and working against it. Let's quantify it. Imagine two investors, both starting with $100,000 in an S&P 500 index fund at the peak of the market in October 2007. Investor A is a student of Buffett and Graham. She understands Mr. Market. When the market crashes, she feels the fear, but she holds on. She does nothing but maintain her position. Investor B is intelligent, but has a poor temperament. As the market falls through 2008, the pain becomes unbearable. In March 2009, right at the bottom, she sells everything, converting her $100,000 into roughly $45,000 in cash, desperate to stop the bleeding. By 2017, 10 years after her initial investment, Investor A's $100,000, having weathered the storm and participated in the recovery, would be worth approximately $200,000. She has doubled her money despite living through the worst crash since the Great Depression. Investor B, who sold at the bottom, is left with her $45,000. Even if she mustered the courage to get back into the market a few years later, she would have missed the most explosive part of the recovery, permanently impairing her financial future. The difference in their outcomes, over $150,000, has nothing to do with IQ, stock-picking skill, or analytical ability. It is purely a function of temperament. It is the multi-million-dollar advantage of being able to calmly ignore a screaming lunatic. Having secured our fortress against external market panic, we must now turn our attention inward to an even more insidious enemy, the relentless emotional urge to act. This brings us to our third pillar, the 20-slot punch card, a powerful mental model for enforcing the discipline of extreme patience. Buffett has often said that he could improve anyone's ultimate financial welfare by giving them a ticket with only 20 slots on it. Each time they made an investment decision in their entire life, they would have to punch a slot. Once they had punched all 20, they could make no more. The effect of this constraint, he argues, would be profound. You would think incredibly hard about every single decision. You would reject good ideas and wait for truly great ones. You would be forced to concentrate on your highest conviction opportunities and to hold them for the long term, because each punch would be precious. This isn't just a clever thought experiment. It's a deep insight into investing psychology. High IQ individuals, in particular, often feel a compulsion to do something. Their minds are constantly analyzing, processing, and generating ideas. This intellectual restlessness translates into a dangerous portfolio hyperactivity, a constant churning of positions that destroys returns. The 20-slot punch card is a temperamental brake pedal, forcing a shift from a mindset of action to a mindset of patient, opportunistic waiting. A fascinating story that illustrates this tension between price, quality, and the patience to wait for the right pitch is Buffett's 1972 acquisition of See's Candies. This was a pivotal moment not just for Berkshire Hathaway, but for Buffett's own evolving philosophy. At the time, Buffett was still very much in the mold of his mentor, Ben Graham, a cigar-butt investor looking for statistically cheap, fair-quality companies. See's Candies was something different. It was a wonderful business, with a beloved brand, loyal customers, and significant pricing power. It was a high-quality franchise. The See family wanted to sell the company, and they were asking for $30 million. Buffett and his partner, Charlie Munger, analyzed the business and loved it. They saw its durable competitive advantage. However, the business had tangible assets, book value, of only about $8 million. Paying $30 million meant paying a huge premium for the intangible value of the brand. Furthermore, Buffett, in his disciplined, price-conscious way, calculated that the business was worth $25 million, and not a penny more. The sellers wouldn't budge from $30 million. For Buffett, this was a clear violation of his pricing discipline. The cigar-butt investor in him recoiled at the idea of paying up. He was ready to walk away. He was following his rules. His temperament in this case was expressing itself as extreme price rigidity. It was Charlie Munger who pushed him. Munger argued that a business of C's quality was worth paying a premium for. He convinced Buffett that it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. The long-term compounding power of a truly great business would more than make up for the slightly higher entry price. Reluctantly, Buffett agreed. They paid the $30 million. This decision might seem like a violation of the quote, patience principle, but it's more nuanced. It was the culmination of a long search for a certain type of company. The punch wasn't just about the price, it was about the quality of the business itself. And once they made that punch, their patience was manifested in their holding period. C's Candies has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It became the prototype for the kind of high-quality, cash-generating franchise Buffett would go on to buy for the next 50 years, companies like Coca-Cola and American Express. The lesson from C's is twofold. First, the discipline of the punch card forces you to hunt for truly exceptional opportunities, not just mediocre bargains. Second, it highlights that temperament isn't just about saying no. It's about having the conviction and patience to say yes, emphatically, when one of those rare 20-slot opportunities finally appears, and then having the patience to hold on for decades. The underlying psychological force that makes this punch card discipline so difficult is what behavioral scientists call the action bias. Humans, especially in environments of uncertainty, are wired to believe that taking action is superior to inaction, even when there is no evidence to suggest that action will lead to a better outcome. In our evolutionary past, this made sense. If you hear a noise in the bushes, it's better to run, action, than to sit still and analyze the situation, inaction. The cost of being wrong and running is minimal, while the cost of being wrong and doing nothing could be fatal. But in the modern world of investing, this wiring is a catastrophic liability. The market bombards us with stimuli, news headlines, analyst upgrades and downgrades, price alerts, economic data. Each piece of information feels like a rustle in the bushes, triggering the primal urge to do something, buy, sell, rebalance. High IQ individuals are particularly susceptible because they are adept at creating complex narratives and justifications for action. Their brain rewards them with a hit of dopamine for solving the puzzle of the day's news, even if the solution is a completely unnecessary portfolio change. This bias is compounded by the fear of missing out, FOMO. When a stock or a sector is soaring, the emotional pain of being on the sidelines can feel like a genuine loss. Your neighbor is getting rich, the person on TV is getting rich, and your inaction feels like a choice to be poor. This is not a rational calculation. It is a deep-seated social anxiety. The 20-slot punch card is a direct cognitive intervention against both of these biases. It reframes the game. You are no longer rewarded for activity. You are rewarded for the quality of your few decisions. It shifts the emotional satisfaction from the doing to the choosing. This constraint forces you to raise your standards so high that the daily noise of the market becomes irrelevant. You are not looking for a reason to act. You are looking for a reason so compelling that it is worthy of one of your precious few lifetime punches. This is the essence of building a robust stock market mindset that prioritizes long-term outcomes over short-term emotional gratification. To put this into practice requires creating a system of forced deliberation. This is the blueprint for building your own 20-slot punch card discipline, a practical framework for achieving financial discipline through structured inaction. Step 1 is to create an investment journal and a mandatory waiting period. Buy a physical notebook or create a dedicated digital folder. From this day forward, you are forbidden from investing in any new individual company until you have first written a minimum 1,000-word investment thesis in this journal. This isn't a casual note, it's a formal memo to yourself. This act of writing forces clarity of thought in a way that simply thinking never can. Step 2 is to structure that thesis around a rigorous, unyielding checklist. Your 1,000-word memo must explicitly answer Buffett's 4 key investment filters. 1. Can I explain in simple terms how this business makes money and why it will still be around in 20 years? The circle of competence. 2. Does the business have a durable competitive advantage, a moat, that protects it from competition? Favorable long-term economics. 3. Is the management team honest, capable, and acting in the best interests of shareholders? Able and trustworthy management. 4. Is the stock trading at a significant discount to my conservative estimate of its intrinsic value? A sensible price tag. If you cannot confidently answer all 4 questions, the idea is an automatic no. Step 3 is to introduce a pre-mortem analysis. After you've written your positive thesis, you must immediately write a second, 500-word document titled, How This Investment Fails. In this document, you must passionately argue against your own idea. What could go wrong? What are the biggest risks? What disruption could make this business obsolete? This exercise forces you to confront the confirmation bias, our natural tendency to seek out information that confirms our existing beliefs, and to think critically about the downside. This structured process of thesis writing and pre-mortem analysis makes impulsive action almost impossible. It transforms investing from a quick, emotional reaction into a slow, deliberate, research-driven process. Each idea that survives this gauntlet is far more likely to be worthy of one of your 20 punches. The antithesis to this patient, deliberate approach is the world of the hyperactive trader. This is the path of the 99%, a world defined by the constant hum of financial news and the frantic clicking of a mouse. The day trader, or even the typical retail investor, wakes up and checks the pre-market futures. They see a news headline about a company and immediately buy or sell. They hear a tip from a friend and jump in. They see a stock is down 5% and panic sell. They see another is up 10% and chase it. Their portfolio is in a state of constant churn, a flurry of activity that creates the illusion of control and engagement. But what is it actually accomplishing? They are playing a loser's game, fighting a war on 2 fronts, against the market and against themselves. Every transaction incurs a cost, either a direct commission or the indirect cost of the bid-ask spread. More importantly, every profitable trade held for less than a year is taxed at the much higher short-term capital gains rate. This hyperactivity is like trying to run a race while carrying a heavy backpack full of taxes and transaction fees. The constant decision-making also exposes them to an endless series of emotional triggers, maximizing the chances that a behavioral bias like fear or greed will cause a fatal error. This frenetic activity is not a strategy, it is a symptom of a lack of one. It is the action bias running rampant, an emotional need for stimulation disguised as a sophisticated approach to portfolio management. The direct financial connection between the punch card mentality and long-term wealth building is one of the most powerful and underrated forces in finance, the deferral of taxes. The impact of tax drag on a portfolio is like a hole in a bucket. It may seem small, but over time, it drains away a massive amount of your potential returns. Let's compare 2 investors over a 30-year period, each starting with $100,000 and earning a respectable 10% annual return before taxes. Investor A embodies the 20-slot punch card philosophy. She buys a collection of great businesses and holds them for the entire 30 years. She never sells, so she never pays capital gains tax. Her $100,000 compounds at the full 10% annually. After 30 years, her portfolio is worth approximately $745,000. Investor B is the hyperactive trader. She also earns 10% per year, but she achieves it by actively trading, turning over her entire portfolio each year. Assuming all her gains are short-term and taxed at a rate of 35%, her effective after-tax return is only 6.5%. After 30 years, her $100,000, compounding at this lower rate, is worth only about $661,000. The difference is over $1 million. This staggering gap in their final wealth has nothing to do with their ability to pick stocks. They both earned the same 10% pre-tax return. The entire difference is explained by temperament. Investor A's patience and inaction allowed the miracle of compounding to work its magic, unimpeded. Investor B's emotional need for action forced her to give up a massive portion of her returns to transaction costs and, most significantly, to the taxman year after year. Patience is not just a virtue, it is a multi-million-dollar financial strategy. Even with a defined circle of competence, a mastery of Mr. Market, and the patience of a saint, there is still one great emotional dragon left to slay: the deep-seated human need for social approval. This brings us to our fourth pillar, developing an inner scorecard to resist the siren song of the herd. Buffett explains this concept with a simple question: would you rather be the world's greatest lover, but have everyone think you're the world's worst lover? Or would you rather be the world's worst lover, but have everyone think you're the world's greatest lover? The answer to this question reveals whether you are governed by an inner scorecard or an outer scorecard. A person with an outer scorecard makes decisions based on what other people will think. Their sense of self-worth is derived from external validation, applause, and consensus. A person with an inner scorecard judges themselves by their own internal standards, by their own assessment of their performance against their own principles. In investing, an outer scorecard is fatal. It means you will buy what is popular, and therefore expensive, and sell what is unpopular, and therefore cheap. It makes you a slave to the whims of the crowd. An inner scorecard, a temperament grounded in self-reliance, is the only thing that allows you to stand apart from the herd, to be contrarian, and to buy when everyone else is selling. It is the final shield of self-control. The ultimate test of Warren Buffett's inner scorecard came in 1991 during the Salomon Brothers scandal. At the time, Berkshire Hathaway was a major shareholder in Salomon, a powerful Wall Street investment bank. The crisis erupted when it was revealed that a rogue trader at the firm had been systematically submitting false bids in U.S. Treasury auctions to corner the market, a blatant and illegal act. The scandal was catastrophic. The firm's reputation was destroyed overnight, its clients were fleeing, and the U.S. Treasury was threatening to ban Salomon from bidding for government debt, a move that would have been a corporate death sentence. The firm was days, if not hours, from collapsing, which could have triggered a wider financial panic. The CEO and other top executives were forced to resign in disgrace. In this moment of extreme crisis, Buffett was asked to step in as interim CEO to save the firm. It was a nightmare scenario. He was leaving the quiet, rational world of Omaha to parachute into the center of a raging Wall Street firestorm. The pressure was unimaginable. He was facing angry regulators, a demoralized workforce, a hostile press, and a financial situation that was deteriorating by the hour. The outer scorecard temptation would have been to engage in complex negotiations, to minimize the financial damage, to manage the public relations crisis, to do whatever it took to make the problem go away quickly and quietly. But Buffett operated from his inner scorecard. His primary goal was not to save money or even to save the firm at all costs. His primary goal was to restore the firm's moral compass and reputation, no matter the short-term cost. In his first address to the employees and later in his testimony before Congress, he laid down his principle with absolute clarity. He said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." This was his North Star. He instructed his employees to be completely transparent with regulators, to report any and all wrongdoing immediately, without calculation. He put ethics ahead of profits. He focused not on what was legally defensible, but on what was right. This was an incredibly risky strategy from a short-term outer scorecard perspective. It could have exposed the firm to even greater legal and financial penalties. But Buffett knew that the only way to survive in the long run was to operate from a foundation of absolute integrity. His inner scorecard told him that reputation once lost is impossible to regain. He successfully navigated the crisis, saved Solomon from collapse, and in the process, cemented his own legacy as a leader of unimpeachable character. He wasn't guided by a focus group or a legal team. He was guided by a deeply ingrained set of personal principles. This is the inner scorecard in its most powerful form. The psychological phenomenon that makes an inner scorecard so rare and so necessary is the immense power of social proof and herd mentality. Humans are social creatures. For millennia, our survival depended on our ability to stick with the tribe. Being ostracized from the group was a death sentence. As a result, our brains are wired with a powerful subconscious urge to conform, to do what others are doing, to believe what others are believing. This is the principle of social proof. When we are uncertain, we look to the actions of others to guide our own. The classic Asch conformity experiments of the 1950s demonstrated this with chilling clarity. In these studies, a subject was placed in a room with a group of actors and asked to perform a simple visual perception task. The actors would all intentionally give the same, obviously incorrect answer. In a shocking number of cases, the subject would discard the evidence of their own eyes and agree with the group's wrong answer, simply to avoid the discomfort of being the lone dissenter. In financial markets, this herd instinct is amplified 1,000-fold. The price of an asset is the most visible and powerful form of social proof. When a stock price is going up, it is a signal that the herd is buying, that they approve. This creates a powerful magnetic pull, triggering FOMO and the desire to join the winning team. When a price is falling, it signals that the herd is selling, that something is wrong. This triggers fear and the urge to flee with the crowd. An outer scorecard makes an investor a helpless victim of this primal instinct. Their sense of whether an investment is good or bad is outsourced to the collective mood of the market. An inner scorecard is a conscious act of rebellion against this wiring. It is the ability to see the herd stampeding in one direction, and to have the emotional fortitude to stand still, or even walk calmly in the opposite direction, armed only with your own research and your own convictions. This is perhaps the most difficult temperamental skill to master in the entire discipline of investor education. Developing an inner scorecard is not something that happens overnight. It requires deliberate practice and a conscious reframing of your definition of success. The eulogy versus resume exercise is a powerful mental model for cultivating this internal compass. Step 1 is to honestly identify your resume virtues. Take out a piece of paper and write down the 5 key metrics by which you currently, level judge your investing success. Be brutally honest. Is it your year-to-date return? Is it how your portfolio performed compared to the S&P 500? Is it whether you beat your brother-in-law? Is it owning the hot stock that everyone is talking about? These are your outer scorecard metrics. They are about comparison, competition, and external validation. Step 2 is to define your eulogy virtues. Now, imagine you are at the end of a long and successful life. A loved one is giving a eulogy, and they dedicate one paragraph to your life as an investor. What would you want them to say? It's unlikely they would read a list of your annual returns. They would more likely say things like, "He was a disciplined and patient investor who never panicked in a crisis. He stuck to his principles, even when it was unpopular. He provided financial security for our family through his steady, rational approach. He acted with integrity in all his dealings." These qualities, discipline, patience, rationality, integrity, are your inner scorecard virtues. They are about character, not comparison. Step 3 is to make this your new measurement system. Put this list of eulogy virtues somewhere you can see it regularly. At the end of each week or month, instead of just checking your portfolio's performance, review your TER decisions for that period against your eulogy virtues. Did I act with patience? Did I stick to my circle of competence? Did I ignore the noise of the herd? Did I make a decision out of fear or greed? This simple act of reflection slowly but surely shifts your focus from the chaotic external world of market prices to the calm, internal world of your own process and character. You start deriving satisfaction not from being right in the short term, but from behaving rightly for the long term. The antithesis of the inner scorecard, the path of the 99%, was perfectly encapsulated by the meme stock craze of recent years, particularly the saga of GameStop and AMC. This was herd mentality on steroids, amplified by the social media echo chamber of platforms like Reddit's Wall Street Bets. A narrative formed. A band of righteous retail investors was taking on the evil Wall Street hedge funds. It was a compelling story, a social movement. And it was powered almost entirely by an outer scorecard mentality. People were buying not because they had done a deep analysis of GameStop's declining retail business model. They were buying because it was the popular thing to do, because of the social validation they received online, because they saw other people posting massive gains and felt an intense FOMO. The rising stock price was its own justification, a social proof feedback loop of incredible power. The goal was not to own a piece of a great business. The goal was to be part of the crowd, to stick it to the man, to post diamond hands on social media. It was investing as a team sport, as a form of social identity, and for a time, it worked spectacularly. But when the narrative broke and the herd turned, the crash was just as swift and brutal. The people who bought at the top, guided by the applause of the crowd, were left holding the bag, their life savings decimated. It was a masterclass in the destructive power of the outer scorecard. The direct financial connection of cultivating an inner scorecard is that it is the only way to realize the truly massive, life-changing gains that come from long-term investing. The greatest wealth-creating stocks in history, companies like Amazon, Apple, Microsoft, all went through long periods of time where they underperformed the market or were deeply unpopular. During the dot-com bust, Amazon stock fell over 90%. It was declared dead. An investor with an outer scorecard would have sold in a panic, desperate to cut their losses and escape the social stigma of owning a loser stock. An investor with an inner scorecard, one who had done their own research and believed in the long-term vision of Jeff Bezos, would have had the conviction to hold on or even buy more. That decision to hold through the pain, to ignore the jeering of the crowd, was the difference between a 90% loss and a subsequent 100,000% gain. The inner scorecard is what allows you to hold on to your winning ideas long enough for them to become truly transformative. It is the temperamental trait that bridges the gap between a good idea and generational wealth. We have now built a formidable defense. We have defined our territory, learned to ignore the enemy's taunts, practiced patience, and fortified our own morale. But a fortress alone does not win a war. It must be paired with a proactive, long-range strategy. This brings us to our fifth and final pillar, utilizing time horizon arbitrage to play a completely different game from the rest of the market. This is perhaps Buffett's greatest and most structurally ingrained temperamental advantage. The vast majority of market participants, hedge fund managers, mutual fund managers, Wall Street analysts, are trapped in a short-term performance game. They are judged by their returns this quarter, or at best, this year. Their incentives, their bonuses, their very careers depend on immediate results. This forces them to think in terms of months, weeks, or even days. Buffett, by contrast, thinks in decades. His default holding period, he has famously said, is forever. This massive difference in time horizon is not just a preference. It is a fundamental market inefficiency he can exploit. He is not playing chess while others are playing checkers. He is planting an oak tree while others are planting tulips. His temperament allows him to focus on the long-term economic trajectory of a business, ignoring the short-term noise that obsesses everyone else. The canonical example of Buffett's long-range vision is his monumental investment in Coca-Cola, which he began in 1988. The context is important. He started buying heavily after the Black Monday market crash of October 1987, a time of significant market fear. But his thesis wasn't a simple buy-the-dip market timing call. It was a deep, multi-decade vision for the business itself. He had been watching Coca-Cola for 50 years. He saw a product that was simple, universally loved, and had a brand that was arguably the most valuable piece of real estate in the human mind. But his key insight was one of scale and time. He looked at the per capita consumption of Coke in the United States versus the rest of the world. He saw that consumption abroad was a tiny fraction of what it was domestically. He didn't see a mature American beverage company. He saw an organization with a quasi-monopolistic product and a growth runway that spanned the entire globe and could last for generations. He wasn't thinking about the next quarterly earnings report or the impact of interest rate changes next year. He was thinking about the hundreds of billions of servings of Coke that would be consumed in China, India, and Latin America over the next 50 years as incomes rose. He famously said he was thinking about how many people out of the world's population would be drinking Coke in the year 2000, 2020, 2050. It was a staggering exercise in long-term, demographic-based thinking. This kind of analysis was simply not being done by the fund manager who needed to outperform his benchmark by the end of the fiscal quarter. Buffett invested over $1 billion in Coca-Cola, making it Berkshire's largest position. That investment has since paid him billions upon billions in dividends alone, and the capital appreciation has been immense. It was an investment made possible only by a temperament that prioritized the predictable developments of decades over the unpredictable fluctuations of days. The psychological bias that makes this long-term thinking so difficult for most people is a concept known as hyperbolic discounting. This is our brain's powerful innate tendency to prefer smaller, immediate rewards over larger, later rewards. We would rather have $20 today than $100 a year from now. This isn't irrational in an evolutionary sense. For most of human history, the future was uncertain, and a reward in hand was worth more than a potential reward later. But in the world of finance and long-term wealth building, this bias is a wrecking ball. The entire structure of modern financial media and Wall Street is a giant engine designed to feed our hyperbolic discounting bias. We are bombarded with daily stock price updates, quarterly earnings reports, and 24/7 news cycles, all of which focus our attention on the immediate present. The pressure for now is immense. A long-term time horizon is a conscious and difficult act of rebellion against this cultural and biological pressure. It requires a temperament capable of delaying gratification on a grand scale, of trading the small, satisfying hit of a short-term gain for the life-changing power of decades-long compounding. It is a true superpower in a world addicted to immediacy. So how do we cultivate this superpower? How do we stretch our mental timeline and begin to see the forest for the trees? The centenarian investor thought experiment is a practical blueprint for rewiring your brain for the long term. Step 1 is to apply a new, radical filter to every investment decision. Before you buy a single share, you must ask yourself the following question. If I were guaranteed to live a healthy life to the age of 100, and I was legally forbidden from selling this investment until I turned 65, would I still be excited to make this purchase today? This question is a powerful mental sledgehammer. It instantly vaporizes short-term considerations. It forces you to think about the durability of the business, its ability to withstand recessions, technological change, and shifting consumer tastes over a human lifetime. It makes you think like you're buying a family farm that will be passed down through generations, not a lottery ticket for next week. Step 2 is to actively shift your research focus from the future to the past. The typical investor spends all their time reading analyst reports about future earnings estimates. The centenarian investor spends 80% of their research time reading the company's history. Go back and read the annual reports from 10, 20, even 30 years ago. How did management talk about their business then? What were their challenges? How did they allocate capital? Did they follow through on their promises? By immersing yourself in the company's long-term history, you develop a much deeper and more realistic understanding of its culture, its resilience, and its fundamental character than you ever could by focusing on next quarter's projections. Step 3 is to consciously seek out businesses powered by generational tailwinds. These are large, slow-moving, almost unstoppable trends that will play out over decades. Think about demographic shifts like the aging of the global population. Think about technological platform shifts like the move to cloud computing or artificial intelligence. Think about enduring human constants like our desire for convenient food or entertainment. By anchoring your portfolio to these massive, undeniable trends, you insulate yourself from the noise of the daily news cycle and align your capital with the most powerful forces shaping the future. Your portfolio starts to be pulled along by the deep currents of history, not tossed about by the surface waves of the daily market. The antithesis to this long-term view is the quarterly earnings game played by the 99% of market participants. It is a spectacle of collective, short-sighted madness. A massive, high-quality company, a global leader in its industry, will report its quarterly results. If its earnings per share come in at $1.30 when Wall Street analysts had arbitrarily forecasted $1.31, the stock can drop 10 or 20% in a single day. Billions of dollars of market value are wiped out because of a one-penny deviation from a guess. This is the epitome of short-term thinking. It is an emotional overreaction to information that has almost zero bearing on the long-term intrinsic value of the business. An investor with a centenarian mindset sees this not as a disaster but as a gift. They see Mr. Market, in a fit of myopic panic, offering them a chance to buy more of a wonderful business at a discount, all because of a rounding error in a 90-day report. This ability to arbitrage time, to buy from those with a 90-day outlook when you have a 30-year outlook, is the most reliable and repeatable edge available to the individual investor. And the direct financial connection, the payoff for this extreme patience, is the most powerful force in the universe, as Einstein supposedly called it, compound interest. The graph of compounding is not a straight line. It is a curve that starts slowly and then rockets upward exponentially. The magic, the truly explosive growth, happens in the later years. By playing the short-term game, by constantly trading, by getting scared out of the market, investors are constantly interrupting this process. They are resetting their compounding clock back to year one. They never allow their portfolio to reach the steep, exhilarating part of the curve. Let's use a stark example. An investment in Microsoft. If you had invested $10,000 in Microsoft in 1990 and simply held it, that position would be worth millions of dollars today. But to get there, you would have had to endure the dot-com crash, the 2008 crisis, and long periods where the stock went nowhere. You would have had to have the temperament to play the long game. The investor who traded in and out, trying to time the market, might have made some decent short-term profits, but they would have missed the exponential explosion of value that creates not just a comfortable retirement but true generational wealth. The time horizon arbitrage isn't just another strategy. It is the master key that unlocks the full, breathtaking power of long-term compounding. You have just spent this time acquiring a profound and powerful tool. This is more than just a collection of anecdotes about a famous investor. It is the installation of a new operating system for financial decision-making, a fundamental shift in perspective that separates the amateur from the professional, the victim from the victor. You now possess the framework that Warren Buffett has used to insulate himself from the emotional plagues of fear, greed, envy, and impatience, the very forces that sabotage the results of even the most intelligent people. You have learned that the most important battles are not fought with the market, but with yourself. But mastering your own psychology, as critical as it is only half of the equation. Buffett's system is not a single principle. It is an interlocking fortress of mental models. The principle of temperament you have just mastered is the shield. It protects you from making catastrophic errors. But a shield is useless without a sword. A shield can protect your capital, but it cannot by itself identify the generational companies, the See's candies and Coca-Colas, that are worth holding in the first place. You have learned how to behave, but what do you buy? You have built the foundation, but now you must learn to construct the skyscraper. And the key to that method, the blueprint for identifying businesses with unassailable competitive advantages, the link that connects emotional control to opportunity recognition, is waiting for you in the video on your screen right now. It is the next piece of the map, the vital connection that turns a defensive strategy into an offensive wealth-building machine. Most people will stop here, satisfied with one piece of the puzzle. They will feel good about what they've learned and go back to their old habits tomorrow. But you aren't most people. The very fact that you have watched this far proves you are serious. The journey to true financial sovereignty requires a complete mental arsenal. The choice is yours. Remain a student or become a master. Complete your education. Click the video.